Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Ever seen a stock double or triple your money in a day? That's the kind of explosive potential leveraged ETFs like TQQQ offer. These funds use borrowed money to amplify returns, turning small market moves into big gains or losses. TQQQ, for example, tracks the Nasdaq 100 but delivers 3x the daily performance, making it a favorite for traders betting on tech stocks. But here's the catch. That same leverage can wipe you out just as fast. These ETFs are built for short-term plays, not buy-and-hold strategies. If you're curious how they work and whether they belong in your portfolio, let's break down the risks, rewards, and smart ways to trade them. Understanding leveraged ETFs, the basics. Leveraged ETFs like TQQQ, 3x Nasdaq 100, or SQQQ, 3x inverse Nasdaq 100, are designed to multiply the daily returns of an index. They use financial derivatives and borrowed capital to amplify moves, giving traders outsized exposure with less upfront cash. But there's a twist. They reset daily, which means compounding works differently than holding a traditional stock or ETF. How TQQQ works for Nasdaq exposure. TQQQ doesn't just buy Nasdaq 100 stocks, it turbocharges them. Here's how. 3x daily leverage. For every 1% the Nasdaq 100 moves up, TQQQ aims for a 3% gain, and vice versa. Derivatives and swaps. The fund uses futures, options, and swap agreements to achieve this leverage without needing to directly borrow large amounts of cash. Daily reset. The 3x target applies only to daily performance. Over time, market swings can distort returns due to something called volatility decay. For example, if the Nasdaq drops 10% one day and rises 10% the next, a traditional ETF would still be down 1%. But a 3x leveraged ETF could lose more because of how the math compounds. That's why TQQQ is best for short-term trades, not long-term holds. Leveraged ETFs versus traditional ETFs. Key differences. Leveraged ETFs behave differently than standard ETFs in a few critical ways. Holding period risk. Traditional ETFs are built for buying and holding. Leveraged ETFs lose efficiency over time due to daily resets. Cost structure. Traditional ETFs have low expense ratios, often under 0.2%. Leveraged ETFs have higher fees, around 0.1% because of the active trading required. Performance path. Traditional ETFs track the index linearly. Leveraged ETFs multiply daily moves, leading to drift in longer periods. The bottom line? Leveraged ETFs are tools for tactical traders, not passive investors. If you're eyeing TQQQ, think in hours or days, not years. The risks of leveraged ETFs. Leveraged ETFs can feel like a fast track to big returns, but they come with serious pitfalls. These funds aren't just riskier versions of regular ETFs, they behave differently under market stress, and their hidden costs can eat into profits. Before jumping in, know the two biggest threats. Volatility decay and high fees. Volatility decay, the silent killer. The daily reset feature that makes leveraged ETFs work also erodes returns over time. Here's how. If the market swings wildly but ends flat, you could still lose money. Take a hypothetical example where the Nasdaq drops 10% on Monday, then gains 11.1% on Tuesday, back to its original level. Here's what happens. A traditional ETF would break even, A 3x leveraged ETF like TQQQ would drop 30% on Monday, then rally 33.3% on Tuesday. But instead of breaking even, you'd still be down roughly 6.7%. This gap widens with more volatility. In choppy markets, the math works against you, making these ETFs terrible for long-term holds. Expense ratios and other hidden costs. Leveraged ETFs charge more than their vanilla counterparts. For example, TQQQ's expense ratio is around 0.88% versus 0.2% for QQQ. The fund's constant rebalancing triggers trading costs and tax events, even if you don't sell. Over months or years, these fees compound quietly, like a slow leak in a boat. You might not notice until it's too late. Then there's the bid-ask spread. Because leveraged ETFs trade heavily, their liquidity isn't always as good as it seems. Slippage can shave another small percentage off your trades, especially during market gaps. The takeaway? Leveraged ETFs aren't free tools. Their costs add up quickly, and their structure works best in smooth, trending markets. When things get messy, they often underperform. Stay tuned for part 2, where we'll break down the risks, costs, and smart ways to trade these powerful tools. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.